So wanted to let everybody know that we are recording this event. Good evening, everyone. My name is Susie Tien. I'm a real estate investor. So today, thank you so much for showing up. I know we have changed the day, but however, we have Bob Bowman here, the creator of the Commercial Underwriter. He's gonna be speaking for us. We are very lucky to have Bob. As you know, Bob is a very busy guy. So Bob, I'm gonna let you introduce yourself in a nutshell because I won't do you any justice.
I'm sure whatever it is will be just fine.
Go ahead and introduce yourself and then you can take it away.
Yeah, well, the short, thank you very much. And, nice to meet everybody and talk to you. And hopefully in some way I can help you and impart some of my experiences that will help you with your own investing, whether you're going to give money and participate passively as a limited partner in somebody else's deal, or maybe you're just going to do your own deal. So I'm going to draw on those experiences. My background in real estate started around 2001. I started doing single family homes here in Orlando, Florida, where we live, my wife and I, and we were doing lease options and we flipped a few, and it was a pretty good business until the real estate crisis came. And then we had to sell our properties before they became valued at such a point where it didn't make sense. So anyway, we went and transitioned to apartments in 2007. 2008, learned how to raise money and bought our first apartment at the end of 2008. It actually closed in January of 2009, and then we kind of took off from there. So the smallest property that we bought was 34 units, and the largest one was just under 400 units. Big difference in how you operate properties. That's a pretty wide spectrum of individual apartments between 34 and 400. But we learned along the way, as we grew our business. And then we also bought some commercial real estate. We bought a 4-story office building in the Dallas area. And then we bought some buildings, a whole park in Charlotte, that we continue to operate those as well. It's about, I think we have about 200,000, a little over 200,000 square feet, net rentable square feet that we manage to. So it's been fun. We've seen a lot of changes over the last 10 years or so. As an investor that buys apartments, we've seen quite a bit of change. And in this year, since January, we continue to see a lot of changes. Some of it maybe not so good, but we certainly need the interest increase that we're having. I think that's going to be good for our business, for those of us that want to buy our own apartments. So I guess the point of our meeting tonight is to share with you some things as from the investor side of some things that you should probably watch for. And so I'm gonna share my screen if I could do that. I don't know if I'm set up to do that or not. I hope so. Let me see if I can do that. Yeah, there it is. So what I'm going to do here is, in order to make some points with you, I want to show you a few things that we need to all be cautious of. So what you're looking at here is a product called Commercial Underwriter Pro. It was a software that I developed. I didn't develop it personally. I have a architect developer, and then I have a second programmer overseas. And I had a vision for software that could underwrite many different types of real estate, whether you want to buy storage units, or maybe you want to buy mobile home parks, apartments, offices, retail, medical office buildings, et cetera. You can do all of that in Commercial Underwriter. So, this is what you're looking at here. This is the software. And just so I can show you a couple things here on my dashboard here that pretty much remain static. I'm always most interested here in the green that stands for money. And this is the annualized cash on cash return. And this is the total annualized return. And so we're going to come back several times to this area right here. Not that we're going to come back to it. It's always going to be here because the dashboard is static, but I'm going to share with you some things here that are important about these numbers as we make changes in this deal. So what you're looking at is actually a real deal. I had to change the name of it. And so I think that today, if I had to share with you the number one risk and the number one vulnerability, if you were going to take your money and give it to somebody like myself, if you were going to be a passive investor, what the risk here and the biggest issue with the risk is these value plays that people are doing. So let me explain that, take a step back for a second. When I started buying apartments back in 2009, 2008, the way that we bought an apartment is that we only based our offer on the income. So when you take your expenses, and if you come back and let me go to starting financials here. So if we took our stated in place income as the seller's financial information off of their P&L. So if we looked at their effective income, which is 1.48, and let me enlarge my screen a bit for you. Might be a little bit easier to see. Okay. So if we looked at the stated in place income and we subtracted what the expenses are going to be, and here's the sellers, we would get here's our total expenses, and then we would get down here after the expenses at NOI, a net operating income. And so this is what the seller would be paying. But when we bought it, we know that we're going to have higher taxes. Property taxes are going to be higher. We're going to operate it a little bit differently. And so these are going to be our expenses here. And then we're going to have a different net operating income number. Okay. And so instead of 747 net operating income, we've got 694,000 because our expenses are higher. Okay. So, when we used to buy a property, our properties were based on income only. And as a matter of fact, surprisingly or not surprisingly, if you were to get a Fannie Mae or a Freddie Mac loan, which is referred to as government agency financing, the type of loan or the loan that you would get would be based on the income that the property produces today. So not the income that the property should produce or could produce, or what the broker said might produce if you put all this money in it. The value of any given piece of real estate at any time is only worth the income it produces today. So what's happened here over time as the market got more and more competitive after the real estate crisis, people stopped buying on the income that it produced today, and they started buying on what we all know is considered a value play. And, in order to get the best out of any investment, a real value play is where you can increase the income and you can decrease the expenses down here. So you're pulling your numbers on both sides to get a higher net operating income. That's really the true meaning to me in a value play. Increase the income and reduce the expenses over time. And when you have a higher, stronger NOI, which gives you a lot more cash, then you're creating a lot of value in that investment property. But, you know, what has happened, instead of just buying it on the income, you know, and one last thing on the buying on the income. So if like when we bought our first apartments back when we were buying based on income, if we were going to fix up the insides of the apartment and make an investment of capital, maybe we would invest 500,000 or, you know, $1 million to improve the interiors and, you know, freshen up the exterior and the landscaping. And we were going to make an additional investment of capital of, you know, to improve the property with the expectation of obtaining higher rents. That was all considered risk. You know, Bob, if you're going to go ahead and you're going to raise all this additional equity from these investors, and you're going to put it in the property, that's nice. It'll make the property nicer, but, you know, we're not going to promote the fact that you're going to get higher rents. That's going to be determined by the market. So even the brokers and the way that properties were sold, the way that they were presented in the property package, you know, rental increases and those kind of values were at a minimum. So, you know, I've seen over the last several years, those value plays go from $50, $100 per month per unit. You know, now I'm seeing them at $300, $400 or more per month per unit. And it just keeps getting, you know, these and everything from the brokers these days are sold on this value play. So since we no longer have been buying on a cash basis on the income the property produces today, Fannie Mae and Freddie Mac, you know, they will not finance properties where the income number doesn't work, because they have to make sure that your debt service coverage ratios, you know, will fall in line with their criteria, you know, which is they want to see a 1.25, meaning that they want to see after your income minus expenses, you know, they want to see a 25%, you know, profit, you know, after you pay the loan. They want to see some cash flow that you've got the money to pay their debt. And that's the kind of the thing about banks in general is that, you know, they really don't care about us. You know, they're providing us this loan, and all they care about is what do we have to do to protect, you know, this loan that we're going to lend in order for you to buy this apartment. So they want to make sure that you have lots of cash flow to make sure that you can comfortably pay that debt. And so because so many things have gone to value plays and there's not enough cash. And so in the last year, most investors that are buying particularly apartments have all sought after bridge debt, which is basically hard money. But what happened a year ago when interest rates to buy an apartment were around 4% or 3.75, these bridge loans, they were even less than agency financing. And what they were doing is that they were allowing you to take the purchase price, add your closing cost, add the loan point for the mortgage broker into part of that was just part of your cost. And if you were putting $1 million into the apartment, they would allow you to add that $1 million into the mix. So here you would have the purchase price plus cost to close plus capital improvements. Now you could never put acquisition fee in there. So you take the total of all that, and they would lend 75% of all of that, which made it very, very, very attractive for investors to buy when they were buying their apartments, because Fannie or Freddie wouldn't finance them anyway, because there just wasn't enough cash in their criteria to pay the debt. And so in the last 12 months, the bridge debt has gone back to its normal, if you will, range of interest rates. And now depending on the lender that you're talking to, bridge debt is now between 6.5% and 9%. It's totally come back to be really true bridge debt. And now bridge debt is more expensive than a Fannie or a Freddie Mae product. So getting back to this risk and looking at a value play and the risk behind it, in this particular deal, if I show you our income forecast and the strategy for this apartment, is that in order to make and to get these kind of returns in the first full year here, you know, we would have to increase the rents $270 a month per for every tenant, okay, per month times for the year. So in this particular situation, what this investor proposed is that they do a $270 rental bump on 50 units that they want to rehab. And then, but everybody in that apartment, this is 128 units, everybody immediately was going to get an $80 a month increase. Okay. And then the second year, they were doing a $230, a little bit less increase, and they were going to rehab 40 units. And then everybody was going to get to a more reasonable $30. So if you've got 80 here and 230 here, you know, for these 40 units, that's over $300 in 1 year. You're increasing the rents. So then the question would be, how many of these people are going to be willing to pay $300 a month increase right away? That's going to be a hard number to swallow. The second thing is going to be, can they afford to pay it if they wanted to pay it and be there? And that's going to be another problem, because now, you know, these tenants were qualified under one set of rent numbers. And now if you take $300 times 12 months, that's $3,600 in additional rent. So if you looked at their income minus their expenses, and you add $3,600 to their rent payments, that's huge. You know, that is a huge number, but this was the only way this investor could make these numbers work. Okay, so now what I want to show you would be very interesting. In a normal situation, you know, we might increase the income 3 or 4% every year for rents. And then we would increase the cost of our expenses now maybe 2 or 3%. So let me show you the risk here and what you're up against and what you should consider. You know, you can see over here that based on the way that this deal was underwritten, there's 11.3 cash on cash return on an average every year for 10 years. The whole period is 10 years. And the overall return is 22.5, which is very, very healthy. 20% is a bullseye. Now, this includes the 22.5 includes the cash return and the annualized equity that you're going to get, the big bump when you sell the property at year 10. So the average return on this particular property was 22.5. Very, very good. But let's just say if you were buying it from a cash basis and you were gonna, where we weren't gonna do this value play, where we're just gonna go in and do say a 4% increase every year for those 3 years. And let me go ahead and save that. Okay, on normal, look at the returns, 5.9 cash on cash return and 8.5 return. So if you don't execute that $270 per month per increase, and you don't do at least 50 units, and if you don't give everybody an $80 a month increase as soon as their leases come up, this is a dramatic difference. This is a loan that'll probably go back to the bank because this is not achievable. So, you know, when you're looking at investing your hard-earned money with somebody like myself or anybody, or you're looking at your own deals, you know, these numbers here, if we go back to that value play here, okay, and the execution of this strategy, not only does it need to be verifiable and consistent with market rents, but it also must be consistent with the quality of similar apartments that you're competing with, as well as the amenities that the competing apartments have and how you stack up against them. So like, what makes you so special? Why would somebody rent from you? You know, so if you're going to raise my rents $300 basically, you know, next year, then I'll just go down the street. They have a nicer apartment, it's newer, and they have more amenities. And so why would I want to pay $300 to stay here at this place? So, you know, when you're looking at, just from a number standpoint, you know, this type of a risk, then, you know, this has to be so solid that, you know, and I say that, you know, only write down the numbers and execute your strategy based on what you can take to the bank, that you can absolutely take to the bank. This to me, and I tell people that I do not have a lot of tolerance for risk, which is why I haven't bought very many apartments at all in the last 3 years, because everything is being sold on total risk. This is total risk. Now, there's nothing wrong with this risk, as long as it's verifiable and as long as it's executable. And there's a lot of things that you need to compare with, because this is basically what I like to say when I look at somebody's deal and how they underwrote it. I want to see that this is a worst case scenario. Is this the worst case scenario? And so what was interesting in this deal here, this is a deal that I'm personally involved in. When we sat down with the management company that's very experienced in the area, and when we sat down and we looked at the market, and when we went to the other apartments, when we pulled all their rents and we looked at the property manager, they said, these numbers are this is definitely obtainable. There was no uncertainty. As a matter of fact, they said, we could get these numbers without having to update any of these apartments. Now, that's what you're looking for. You know, they said, we can get these numbers without updating a single apartment. And so that, you know, and if they really believe it, and the market is there to prove these numbers out, then, you know, you have yourself a really decent deal, okay, that you can execute. Now, it's a good deal. This is a really good deal. And so this would be something that I would consider doing. But to me today, you know, I had somebody bring me a deal. They had a value play right here, and the number was $380 a unit, which was even huger, right? Remember I was saying they're getting up to $350, $400 a unit per month, because they have to find more increases in order to make these numbers work for the investor, right? So this person that will remain unnamed brought this deal to me. And so what I did is I pulled the rent roll, because they were telling me they were getting these numbers without doing any rehab. And they had started rehabbing, and it was a piece of cake. Well, make a long story short, when we took all the units that they rehabbed and we did an average of the 1-bedroom, 2-bedroom, and 3-bedroom, and we looked at the current rents, because they told us they had started increasing them $300-400 a unit, we found out in the entire complex that the average rent increase was only $22. That's all that they were getting, even on the renewals in today's market. This was a deal about 7 months ago, 6 months ago. It wasn't long. And so when this person went out there and they looked at the market and they looked at this asset, they realized that the way it was being sold to them, that by the broker, that those numbers were not obtainable and they were overselling the product. So anyway, this is the number one risk to me. Okay. This value play and your ability to execute, and also what does the market tell you that you can really do. Okay, because you can make an apartment look really nice and you have control over that, but what you have no control of is what other people are charging for rents in a similar apartment. You have no control over that, and that's the magic number right there. Okay, so that's number one. The number two problem right now, when you're looking at investing your money in somebody else's deal, and I'm going to change screens here, is bridge debt. Okay, because this is our primary debt, and if this was bridge debt where everything was being financed in it, the problem with bridge debt is that the interest rates are typically not fixed. They're not fixed. And with interest rates that have been going up, and then beginning January of this year, they really started to go up. And we've already had multiple increases, with another one being just yesterday. So let me give you an example of somebody this is a real story, something that we had a deal in Oklahoma City, and it was over 250 units. We made it to the best and final, but we came in second. We didn't get the deal. The buyer bought the property for $16 million. Our offer was 15.3. We were $700,000 less than the other buyer. So the seller chose this buyer. This deal happened about 15 months ago, so it's been slightly more than a year. So they bought the property for $16 million. They had closing costs, they had acquisition costs, and they probably had like $1 million, $1.5 million of capital improvements that they needed to do to this property to obtain the rents. And so this property just came back on the market a few days ago. And the buyer, that's now the seller, that just bought it for $16 million, wants $18.5 million now, and in just a little over a year. And the problem here is that they're desperate now because their interest rate here went from whatever they paid for has now gone up to the extent that they're really close to break even. You know, they don't have any more money. They can't obtain the rents because they didn't execute. But the biggest thing is that the rates went up, and now they have to sell the property, and they just can't sell it for $16 million because they have all this equity, additional equity they borrowed from their investors to pay these closing costs and these capital improvement dollars. So they're in big trouble. Now, a lot of companies, when you have an interest rate and you're getting a bridge loan, they spend the extra money to buy a rate lock cap. So what happens, and I've done that once before earlier on, is that if you're buying at a 5% interest rate, you can pay X amount of dollars, and maybe they cap your interest rate at, say, 6.5%. So if the market goes above 6.5%, you only pay 6.5%. And every dollar over that, this third-party company pays your mortgage. They write the check for everything over 6.5% until you sell the property till the end of the term, which is really cool. But, a lot of companies thought that, or for whatever reason, they didn't need a rate cap. And that's what happened to these guys, we're sure, because it required a bridge loan, because we analyzed it that way. And now they're in this position that's for us, this is the thing that is, I think we're going to see more of these properties back on the market. So if you're an investor and you want to use your money to invest in somebody else's deal, you really want to pay attention to bridge financing, how it's being done. Is it a fixed rate or not? And for how many years? And in a Fannie or Freddie, in a traditional agency loan, it's always fixed. It's rarely a adjustable rate mortgage. So that is a big problem right now for some people. Okay, so you want to, right now, because, bridge debt has taken, a huge jump in interest rates. You in some deals, it's going to be borderline whether you use a bridge loan or you use a Fannie or Freddie if you're buying an apartment. But just make sure you ask that question and what that debt is, because if not, like these guys, they're going to, if something doesn't happen here for them, they're going to, not only is the deal going to go back to the lender, but what happens is that the investors will lose all their money because the bank will now own the property, not the guys that actually bought it. And then the bank will just sell it off and nobody will get anything. And it's really, that's not a position you want to be in. You don't want to lose your money when you get it to somebody else. It's one thing you don't make any money, but if you don't make any money and you lose your money, boy, that's a really tough position. So be really careful, because there's so many changes happening right now out in the debt market that you want to make sure that whatever interest rate that they use, is something that is going to stick during the term of your investment. So that's probably just as important today as it is, evaluating the risk involved with doing a value play. Okay, and buying a property that needs a bunch of work and you're going to make a bunch of money because you're going to really increase the rents. So the third thing that you need to ask yourself, a lot of people buy working class properties, C properties in, good areas. And what's happened in the last 2 years or so with the rising cost that we've all been affected of, the cost of goods and groceries, and now interest rates on these people's credit cards. If you have tenants that were paying on their credit card, now their cost is going to be more, because if they don't pay their credit card off, now their interest is going to be higher. They're going to be suffering higher balances and higher monthly payments on their credit cards, which could affect their ability to pay your rent. The other thing about C properties and working class properties is that there's already been so many increases in rents and so much pressure put on people that, work paycheck to paycheck, or maybe they work month to month. And if you go in and say, oh, well, we're just doing a $270 a month increase in rents, and that's your tenant demographic, I would say that's going to be a recipe for disaster. Because if you have a C property in a C area, you're going to be drawn from working class tenants. If you have a C property in a B area, where you have people that have more disposable income, maybe you have gray collar instead of blue collar, and you're going to fix up the apartment, you could probably maybe move it up from a C to a C plus and bring in some of these young professionals or people that, are going to have a little bit more money, be able to pay a higher rent. But if you have a C property in a C area, you could be in big trouble. Okay. So you really want to, pay attention to what is the strategy, what is the location of the property, where are these tenants going to come from that are going to pay the higher rents. And just keep in mind, if it's a C property, these properties are typically built in the 60s and 70s, maybe early 80s. And so, I just don't see where you can put any more or much more financial pressure on them. As a matter of fact, in a number of cities today, people that are getting pushed out of their apartments and they're getting pushed out of their houses that they're renting, it's become a big problem, especially, we've had it here in Orlando. It's gonna go to court, but they're looking at doing rent control here. So, owners are not happy about that. But, if you want to buy a 1-bedroom apartment now, you're going to pay probably $1,800 or $1,900. And if you want 2-bedroom, you're going to pay $2,000 to maybe $2,200 for 2-bedroom. Just a couple years ago or so, you could get a 1-bedroom for, $1,000. Maybe $1,200 if you were down by Disney or Universal Studios, in one of those nice apartments, and maybe 2 bedrooms were $1,300 or $1,200. But now they're all near $2,000, and people are being pushed out, and there's not a lot of places to live or rent. So now people are wanting rent control. So anyway, something that you should pay attention to is the tenant demographic, and what the strategy is, and who's going to pay these higher rents. Okay. How are we doing so far? I'm gonna share one more thing with you.
We're doing great. Do we ask question after, or can people ask question as we go?
Well, I mean, they can start asking questions right now if they have it. We can take it while it's fresh in their minds.
Sure. All right. So go
If
ahead.
anybody has one.
If anybody has any question right now for Bob? Alex has a question. Go ahead, Alex.
Hey, Bob, can you just go over the metrics in your little table at the top? I'm not sure I'm familiar with all of the metrics.
In the dashboard here?
Yes.
Yeah, so for instance, the reversion cap, reversion value, desired yield, NPV, and IRR.
Okay, sure. The dashboard is something that I created because one of the things that affected me was when I used Excel, was having to go through all the tabs. And one of the things that was important, if I make any change to my underwriting, whether it's an interest rate change, I want to be able to see the immediate effects it has on the investment property. So what I've done here is basically broken everything out into 3 colors. The blue colors are basic information. The pinkish colors are more sophisticated information for a more sophisticated investor or lender. And then the green for me stands for money. So that's why I will look at the green a lot. That's my favorite color. So so going through the dashboard, the product, when I created this, I wanted to be as accurate as I could with my numbers that you're looking at here on this dashboard, because so everything is based here on a calendar from a January through December, because everything that I do when I operate an apartment is always done on a calendar basis. So the software is when these numbers you're seeing here, and I'll answer your question, but everything is divided by 365 days, so from our start date. So that's what this is right here. This is that first, this is when we plan, which is basically, it was the end of the year. The hold period is, this is how long we want to hold it itself. And then what we have here is that we have a reversion cap rate. Now, the reversion cap rate is, you may know it as the terminal cap rate. And this is the cap rate that you're planning to sell the property at 5, 7, 10 years down the road. And the reversion cap rate, basically, you take the NOI, divide it by the cap rate to get your selling value 5, 7, 10 years down the road. That's your reversion value. That's what these are. And so, if you're buying at a 6.8 cap rate, you need to really be using a reversion value of a point to a point and a half higher when you're selling, to anticipate the changes and the increases in interest rates that are going to devalue your investment. So it's really important that you change. You don't buy at a 6.8 and think you're going to sell it 3-5 years down the road for the same cap rate. As a matter of fact, for the last several years, the agencies, all of the private money companies, the more sophisticated investors has been doing that, has been adding a point and a half in their own underwriting because everybody expected that the interest rates were going to change over 4 years ago. And usually when things in the economy and things change, it's usually after an election. And we had a really long, one of the longest real estate cycles ever. And so and we also had the lowest interest rates ever that we've ever seen. So when Donald Trump came in, everybody really, if you read the reports on Wall Street and some of the communications earlier on, everybody thought, okay, well, we've had our run on real estate and interest rates are going to most likely now go up. It's time for that sea change. And what happened, surprisingly, not only did interest rates, did they stabilize, but they went down and was even less and got down into the 2.75 and 3.25% that nobody ever expected. So then the new president that's in office today, when he came in, everybody expected this change, but what happened, it got a little bit off the rails because of COVID. And then COVID really has had an effect on everything and on our economy. But all the smart money, if you're going to value apartment, make sure that you use a higher cap rate.
So quick question on that, Bob, is you're just being conservative and adding a point, but what if you're in an emerging market? Would it be fair to keep it the same, or even in an emerging market, you should add a point?
No, even in an emerging market, because rates are going to change. Rates are going to change. Yeah,
Okay,
you
gotcha.
need to, yeah, I would be, yes. And again, everybody has been doing this for probably the last 5 or 6 years at least. As I said, everyone, we all thought that the things were going to change. So then, of course, let's go right straight to the pink. All these are tied together. I actually have in my user's guide, I know some of you here actually use Commercial Underwriter. I have a little user's guide. So in the dashboard, if you wanted to look at the components, I have a whole explanation on everything that's here. And this is how the net present value and the internal rate of return are actually, these are formulas used against the purchase price and the desired yield. And it says, basically, I'm saying, I want a 20% annualized rate of return. And because of the way that I'm buying this property, your net present value here, my net present value is negative, which means I'm paying more for the property than I should be. If I want a 20% yield, I'm paying 1.9 million more, so if your net present value is higher, if it's a positive number, that means you're getting a great deal on your purchase. But that's because everything is underwritten on a value play when you're buying an apartment. And that's kind of the deceptive thing, because if you're, in the reality is if your net present value is negative and you're paying too much for the property, look at the returns. You're actually exceeding your desired yield, but that's all going to be based on you know, this value play in your income forecasts, you know, saying, hey, you know, this is what I'm going to do. But the software, you know, when people actually look at the deal, they're going, hey, Bob, this is not a great deal. And the project at project level, it only has a 13.6 internal rate of return. So, you know, these are real numbers. Those are tough numbers to swallow, and that's what you're going to end up with if you don't execute that strategy. So these are all tied together into the purchase price and the kind of returns you're looking at. Now, if you take your desired yield, and let's just say, you know, instead of desired yield at 20, you know, if I only want, you know, say a 16% total return on the investment, and I save that, look what happens to my net present value. It's only $864,000 negative. It's a much better deal. I'm only trying to get to 16 now instead of 20. So my net present value has improved. So it's kind of interesting. You know, a lot of the more sophisticated, you know, equity companies and their analysts, and, you know, when you're trying to get private money for your deals, a lot of them like to look at that. But, and then of course, you know, the green I've already explained. You know, this is pretty self-explanatory here. And then this is my annualized cash on cash and my annualized total return. And like I said, this is what I really look for. And this is all project level. You know, I also have investor internal rates of return in my return numbers here, you know, and if you know, put up 100,000, I can tell you exactly what you would make, you know, based on how the deal was underwritten. So, yeah, so that's the dashboard. You know, you notice as I go through the screens, you know, it's static. It's always there. So I always know that change that I made, you know, how did it affect my outcome? Okay. Did I answer all your questions on that?
Yeah, but I think if you could just distinguish between internal rate of return and intent total annual return.
Okay. Between this number here and this here.
Yeah, I guess it's not clear to me
Okay.
why you have such a big delta between the.
Yes. Well, first of all, yeah, your internal rate of return is the cash discount on your money over 10 years. That's the discount. That's the formula. That's what that dollar is supposed to be worth. It's a standard formula. You know, we don't pay our investors on internal rate of return, and people just want to know what it is. But I'll be honest with you, I only follow the cash. I don't follow cap rates. You know, I just want to know how much juice is in this deal. Do I have enough cash to pay the investor? And then is there enough money for you and I to make doing this deal worthwhile for us? And that's what I really focus on, to be honest with you. But the internal rate of return is the discount of the money, because the dollar every day, every year, you know, isn't worth what it was 10 years ago.
Gotcha. Okay, thanks.
Yes, good question. Thank you for asking that. Is there any other questions?
Yeah, I have one. So I'm trying to just understand. So you said that this was a good deal, but if they raise the rents to the 270, aren't you putting yourself in position to lose a lot of tenants? So how does that remain? How does this remain a good deal if that is the outcome that's most possible when you're trying to raise somebody's rent $300 in 1 year? So
Yeah.
what is still a good deal?
Yeah, that's a really good question. And the answer to that question is that we do plan on turning all the tenants. We do plan, because they're going to have to get requalified, and they were qualified on a much lower rental amount. And so, we know that the majority of them are not going to qualify. The second thing is that we really do want them to move, because we can't go in and execute our business plan and fix up that unit until they do move out. And so in anticipation, right now the property's at right here, 6.5% vacancy. So we changed it during the transition period to 10% every year. We have to be careful with that, that we have a balancing act here to make sure that we keep the occupancy up close to 90% by getting in there and turning those units quickly. So, these tenants are going to flee. Some of them might even skip out, or we just won't renew their leases either. So, we want them to move out.
It's part of the strategy, huh?
What's that?
So it's just part of the strategy. So once they move out, then it's a cleaner apartment, and you can just go right in and do your improvements and then re-rent it at the new rate that you want. Okay.
That's right. Yeah, because you can't get in there and do it until they're out. When you're doing flooring, particularly, you're painting all the walls, you're painting inside, and you're making some of these improvements, and you have lots of contractors coming in. Boy, you don't want anything to slow you down. So until their unit is turned and they're completely out, and you do your clean out so your contractors can get in, it's a pretty good size coordinated event, to be honest with you. I know somebody, I would not suggest that you do this, but he was one of my partners earlier on. And by the time we had about over 1,000 units at the time, he bought an apartment in Winston-Salem. And what he did is he raised additional capital because he was improving all the units, but he wanted to do everything. It was about 100, a very similar size apartment as this. And so he wanted everybody to move out. So the day that he bought the apartment, he put notices on everybody's door that he was raising the rents, whatever it was, and people just started fleeing. And as they moved out, I mean, he had his contractors right in there, and they were turning those units. They were getting new tenants in. They were increasing those prices, and he made sure he had capital to pay his debt every month. But he was on a mission, and he turned that whole apartment in a year. I've never seen anybody do that. But because he was local, he was experienced, he knew the market, and he felt that that's what he wanted to do, and not string it out over, 3-4 years or whatever we normally do. That's what he chose to do. A lot of risk in that, but boy, did he got it done.
That's exactly what I was about to say. I'm like, that's very risky.
Yeah.
I guess if you know your market, you can do that kind of stuff. But deal like this deal that you have, when do you start paying? Will you start paying the investors? When you start giving them probably the second quarter, or when?
Well, I never pay out immediately. There's a couple ways you can do it. You can do a cumulative one where they get returns from the very first day since you close, or it is an investment. I've done mostly non-cumulative, but in terms of actually given capital or cash to an investor, I like to do it and take an assessment after the first full quarter, because whenever you get into any investment, this first year is when we have our lowest income and we have our highest amount of expenses. And I've actually been criticized by sophisticated investors that tell me that, Bob, you shouldn't do anything until after the first year. Let's just see how the business goes. Let's go in there, do what we need to do. Let's start getting these rent increases and exercising. And then, if the capital, if we're coming from a strong financial position and executing, then let's look at the distributions and doing it. That kind of language comes from, experienced people that understand business. And so what I've always done, I've never done quite that. I like to, whenever we close, the quarters go from January through March, April through June, et cetera. And so whenever I buy the property, I always wait until I get through one full quarter. So no matter where I close. So if I close in February, I'm not going to, the end of my first full quarter is going to be at the end of June. And so after the end of June, we balance everything out for the quarter. We get our bank statements. We look at our cash position. We look at what we have to do. And then it's at the end of July. It's 30 days. Within 30 days from the end of the quarter, then that's when I'll consider doing my first cash distribution. The thing that is deceiving about that is that, you still have, typically, if you're only been in the deal for 3 months or 4 months, 5 months or so, you still have a lot of cash. And sometimes it looks like you have a lot more cash than what than you really have, because, this capital that you get from the investors to make the improvements, you only get one shot at it. And if you don't use that money wisely and execute that strategy to get that additional income and get that equity and build that value up, it's going to have an impact, on your investment and your investors down the road and your ability to make those payments, because, now you're short of capital to finish your strategy. And the last thing you want somebody to do is a cash call, meaning you have to go back to the investors, or sometimes it's called phantom income, when you say you give your investors $10,000 for the year for their distribution, but then, now, you need money and you got to ask them to return the money or return partial. They call it phantom income, is income that you never had to begin with. Because the first priority as an investor is to protect and preserve the capital of the investors. That's my number one priority: preserve the investors' capital. And therefore, when I'm looking at an opportunity, it's really important, from the financial side, to make sure that I'm protecting the property. And what it's called is that once you start taking money out that you really don't have, and you're making distributions, and that you really don't have enough capital, it's called equity stripping. You're actually stripping the equity of the property because you put yourself and your investors in a less desirable cash position. And, you have some quarters and things that are better than others, just like everything else, which is why I do non-cumulative and not cumulative, but just something to keep in mind. You just don't want to start, doing distributions too quickly. Good question.
Great. Any other questions, guys? Bob, do you have any more stuff you need to discuss? I know we have stopped you and start asking questions, so I don't know if you have any more stuff. It's already 8 o'clock.
Yeah, I think it's getting late, and
Right.
for a lot of people, and I appreciate their time. I could talk for a lot longer. I love the business. There's so many aspects to it, but if you're going to be an investor, and you would like to know more about my software, if I could, and underwriting, I do learning labs, which are free education on underwriting and valuing all different types of real estate for those that subscribe to the software. That's a part of my program. So if you want to, Suze, you can give them my email address or my phone number. If you have a deal and you're looking for someone to sponsor it or be a part of it, I'm happy to do that. We're looking to, we sold most all of our properties, especially before the interest rates went up, the things that we really wanted to sell. And now we're looking to rebuild and buy more property. So if you have something that you'd like for me to look at with you, be happy to sign a confidentiality or whatever it is. And I'm here to help you. And if you'd like to learn more about the software, you can always call me. And Suze, if you could, is there a way you can give everyone my contact information?
Yes, definitely. But I think we have regarding this right now, you said the learning lab, when gonna be your next learning lab? For the poll, I know people
Yeah,
have this gonna
I
get
think I'm gonna have to do it on Tuesday of next week.
next
I-
week. Okay.
Yeah, it's gonna be Tuesday. Uh-huh.
Okay. So I think one of the things, I was in a meeting the other day on Tuesday night, people were very concerned that rent going to go down um as we go further. So what are your thoughts about that?
Well, first of all, I have to know a little bit more about that conversation, and I think that's an interesting, why did they say, and who was saying rents were gonna go down?
But there has been a lot of articles out there saying rent's gonna be declined pretty soon. I don't know whether people talking about rent control or anything like that, but they're saying that if we get into a recession, rent gonna have to come down. And some other people have been saying there has been they have seen rent going down in some other cities properties. So that's why, since you say you sold most of your properties, so I don't know if it's something you guys been following, or if you guys think it's just people just talking, or if it's something that's gonna actually happen.
Well, I think that something like that, first of all, I haven't heard that. I haven't read about that. I could see the possibility if inflation keeps going up. And when you get to a point where people can't pay the rents and you start looking for delinquencies, and you start, people stop paying their rents on time, and they start getting more and more late, and your delinquency reports are growing, and you're having problems collecting your rents because people just can't afford to pay more. That gets into some pretty dangerous territory. I think, that if that happens, I mean, I think the whole country is going to be in pretty bad shape. So, usually what I find is that, and I'm sure for those of you that, have been around for a while, especially if you're over 40, you know that once prices go up, they rarely go down. And if they go down, they just go down, just a little bit, because part of it is that how do rents go down when expenses are so high? You have to be able to pay, your expenses, and pay your vendors and pay your property taxes and pay your lender. So, and then, you have to make sure that you maintain that debt service coverage ratio with the lender. If not, they put you on warning. They give you 90 days to cure the problem. And then if not, you get a second warning, and then they take back the property, and then everybody loses. So, having rents go down with high expenses, is going to be really hard. But if any of that happened, I think that, this would be a lot more than a overall market casual rent decrease. But I'll have to keep my eyes and ears open for that. If you have any articles on that, Suze, that you've read, or, you could pass along, I'd love to read it. But at this point, I'm not hearing about any kind of dramatic or any kind of rent decreases.
Yes, you are right. I think they were in the same line you're talking about. They were talking about if the inflation keep on going up and then interest rate keep on going up. So those were the two factors they were looking at when they say that. And you're right too, by saying we never see anything go up to actually come down. Yeah, that's one of the things that was like, I was a little bit, I don't know if this is really true, but I think right now a lot of people have a lot of opinions coming out with everything's going on. And we know for sure the next 2 quarters not going to be as easy as we see where things are heading at this point. But yeah, so definitely a lot of people going to be back in the market selling their properties.
Yeah. What's kind of too bad. I heard somebody talking about this the other day, because they know a vendor, since the supply chain of products is now, people are getting product now. It's gotten a lot better than it was 6 months ago or 10 months ago. And now people are sitting on a lot more product, but they haven't reduced their prices. You know, before it was high demand and no supplies. Now people have supplies and they're making huge profits. You know, and they have the inventory, but it's not going down. So I used to pay, before COVID, I could buy a refrigerator all day long, a black one or a white one, just good standard refrigerator for $480 from Home Depot or Lowe's or HD Supply. And now I'm paying almost $700 for the same refrigerator. And my prices still haven't calmed down. And I know there's lots of refrigerators out there now. I know it's still not the ideal supply levels, but it's improved significantly, but I'm seeing no change in pricing. So anyway, we'll see. We'll have to see what happens here. Even in Orlando, when I mentioned about rent control, nobody said a single word about reducing rents. They only talked about controlling the rent so they don't go higher. So anyway, it's an interesting time.
Right. Anyway, thank you so much for coming here tonight. And
Can I ask
Stacy, you have a question?
Yeah, just Bob, now that you're open, told all your portfolio you're open, are you still, what markets are you open to investing in or looking in?
Okay, Stacy, you broke up really bad. I think
yeah.
I'm sorry. What markets are you looking to invest in now?
well, because of our experience, these are pretty broad, but let me just give you generally. I love the Southeast, the Southwest, and the Midwest. Nothing on the West Coast from Washington, Oregon, California, nothing in New England or the mid-Atlantic states. They're just too expensive, you know, rarely any cash flow, too competitive, you know, just too hard. So, you know, if you look at a US Census Bureau map, you know, one of those time delays where they take you through the last 10 years, and they also have one for job growth. If you look at the population growth and the job growth, you'll see that everything is moving southeast and southwest. And when you create jobs, of course, the people come for the jobs. And so that's why, you know, there's so many good emerging markets and people that want to, you know, move southeast and southwest. So as long as the property, as long as there's a good way to manage the property, if, you know, because most of the time the properties are not going to be in your backyard, they may be remote. You know, the key of our success is a really good management company who's going to execute our strategy.
Okay, thank you.
Okay, you're welcome.
All right, we're gonna cut it here. It's already 8:13. So thank you so much, everyone, for coming here tonight. And we will resume again in 2 weeks on Saturday. And Bob, thank you so much for coming here and impart your knowledge and in this good discussion we have tonight.
Yeah, well, thank you for the invitation. And, you know, again, Suze, if you could give everybody my contact information, if I can help any of you in any way, I mean, I don't have to be in your deal. If you just need help, I love to underwrite and put deals together. And I help a lot of people. By the way, I don't charge for that. I just help people. So if you've got something that I can help you with, if you need anything, just remind me that you were on this call, so I know that you're connected with Susie, and that would be much appreciated, so I can put that together. So, thank you, everybody, very much for your time, and good luck.
Thanks, Bob.
Okay. All
Yes,
right.
I'm putting Bob's number in the chat. So if you guys interested and would like to talk to him about a deal, so you guys can contact him like that. Okay, thank you, everyone. Bye.
Okay, good night, everyone.
Good night.
was just waiting my time to put it. Hi, Trent. Hi, Bob.
Hi, Sis.
All right, bye, everyone. Good night. I put Bob number here for those of you who don't have it. And also his email is Bob Bowman. Let me put it in there, Bob.
Hello, Suze.
How are you?
Fine. How are you?
Good. I haven't talked to you since UP. Bob
You
Bowman.
still got those pretty braids on that you had there.
Yes, that's really bad. Gonna be here for a minute. At least 6 weeks, because I waste a lot of my time to get them there.
So the
All
next
right, so
call is in 2 weeks.
what was that?
You said the next call is in 2 weeks. Is there a different link or do we still use this link?
It's gonna be a different link. I'll be sending it.
Okay.
Yeah, I usually send the email and the link so people can go ahead and join. And that's what it's gonna be.
All right.
Yeah. Thanks, anyone. Good night. Have a good one. Bye.